Hey everyone, we're here to talk about financial statements. Let's explore and understand its different types. So our agenda for today is to introduce the topic, which is the financial statements, learn about the income statement, the balance sheet, the relationship between balance sheet and income statement, the statement of owner's equity, the statement of cash flows, common size statements, and end up with a conclusion. Financial statements are formal records of the financial activities and position of a business, person, or other entity. These essential reports provide a thorough overview of the viability, performance, and financial health of a business. It gives stakeholders important information about an organization's financial situation. These statements are the income statement, balance sheet, statement of owner's equity, and statement of cash flows. Each statement provides a different insights into a firm's performance and financial health.
Net income, or what is commonly referred to as the bottom line. Net income or loss reflects the net impact of all financial transactions for the firm, including those that are caused by events outside the normal course of business. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Amortization is similar to depreciation. It is the spreading of the cost of an intangible asset over the course of its useful life. Intangible assets are long-term assets that lack physical substance, such as patents and copyrights. The classified balance sheet shows the financial state of a company as of a specific point in time. It is a key distinction between the two statements. The classified balance sheet is prepared in sections that align with accounting equation. The classified balance sheet is thus broken down into three sections: asset, liabilities, and owner's equity. If prepared correctly, the total assets in the balance sheet equals the total liabilities and owner's equity as of the balance sheet. The balance sheet shows us what the firm has, its assets, who owns them, equity, and who the firm owes, its liabilities. Estimates are another limitation of the balance sheet. Another key limitation is the fact that the balance sheet reflects balances at only one given point in time. There are many possible things of value that are not recorded on the balance sheet. Internally generated assets and the firm's human capital are two common examples. Internally generated assets can be anything from a website, a process, to an idea. The statement helps financial statement users understand the sales generated during the period and the expenses incurred to generate those sales. If the expenses are smaller than the sales, the net result is profitability or net income rather than a net loss. The first section of the income statement begins with sales. Though financial statements are required to follow a certain format, account names can differ slightly from one firm to another. You may see the first line, often referred to as the top line, called sales, sales revenue, revenue, service revenues, and other similar titles. Gross profit is a reflection of how profitable the firm's performance was in its core business function. It includes only the core business and direct costs of performing that business. The cost of goods sold, COGS, is deducted from net sales in order to arrive at gross profit. It is customary to refer to sales minus COGS as gross profit because gross margin, gross profit or sales, cost of goods sold includes the costs directly involved in making the product that was sold during the period. Common examples of costs include in cost of goods sold include direct labor, direct materials, and the overhead assigned to the product in production. Note that different types of companies will have different types of costs deducted in their cost of goods section. After gross profit is calculated, other operating expenses are deducted in order to calculate the firm's income from operations, also commonly called operating income. Common operating costs found in this section include building rent, utilities, property taxes, wages, and salaries, and other overhead costs.
The relationship between balance sheet and income statement. The financial statements are linked by certain elements and thus must be prepared in a certain order. Remember that financial statements are interconnected with each other, meaning that you cannot proceed to make the next statement without certain elements from the other statement. The result of the income statement feeds the retained earnings account on the balance sheet. In the income statement, the net income is computed, and this net income will then be in the retained earnings section of the balance sheet. Expenses versus payables. There is another key relationship between the income statement and the balance sheet that can be often confusing to non-accountants: an expense versus a payable. So to clear things up, expenses are the costs associated with providing goods or services, while payables are the accounts due to sellers or contractors for the goods and services that are not paid in cash. It is similar to buy now, pay later. Accounts payable is a liability found on the balance sheet, while expenses can be found on the income statement. The expense incurred causes a payable, but it is distinctly separate from the payable. For example, the business paid the utilities on account. This will then be included on the expense part of the income statement. And since they paid it on account, this will become a payable, which they will soon pay on the date that they agreed to. The statement of owner's equity. The statement of owner's equity is divided by each type of equity the firm has: common stock, preferred stock, additional paid-in capital, and retained earnings. For example, beginning balances are provided, and all key transactions impacting equity are provided in order to show how ending balance were derived. Key transactions commonly include recording net income or loss, issuing additional stock, and paying out dividends. The stockholders' equity section of the balance sheet for corporation contains two primary categories of accounts. The first is paid-in capital or contributed capital, consisting of amounts paid in by the owners. The second category is earned capital, consisting of amounts earned by the corporation as part of business operations. The common stock. It represents the ownership in the firm. The preferred stock. It has unique rights that are preferred or more advantageous to shareholders than common stock. Treasury stock. Shares that were outstanding and have been repurchased by the firm but not retired. Additional paid-in capital. The difference between the issue price and par value of the common stock. Dividends. Dividends are commonly in the form of cash, but dividends can be paid out in the forms of stock or other assets as well. Cash dividend, a payment made by the company to its stockholders in the form of periodic distributions of cash. Stock dividend, a payment made by the company to its stockholders in the form of stocks. Property dividend, the firm pays out dividends in the form of something other than stock or cash, often one of their assets or something they hold in inventory.
The final financial statement is the statement of cash flows. What is the statement of cash flows? A cash flow statement tracks the inflow and outflow of cash, providing insights into a company's financial health and operational efficiency. Statement of cash flows measures how well a company manages its cash position, meaning how will the company generate cash to pay its debt obligation and fund its operating expenses. Importance of statement of cash flow. Statement of cash flows is crucial wherein it provides valuable insights into a company's financial health. By analyzing cash inflows and outflows, businesses can make informed decisions about budgeting, resource allocation, and financing needs. The statement of cash flow helps with forecasting future cash flow and identifying potential shortfalls. Most companies use the accrual basis accounting method. Accrual accounting is a method where revenues and expenses are recorded when they occur, not necessarily when cash moves. Accrual accounting is a financial accounting method that allows a company to record revenue before receiving payment for goods or services sold, and record expenses as they are incurred. In other words, the revenue earned and expenses incurred are entered into the company's journal, regardless of when money exchanges hands. Accrual accounting is usually compared to cash basis accounting, which records revenue when the goods and services are actually paid for. What is the other difference between them? The RIC method is a user-friendly method, especially those without extensive knowledge about accounting. It can easily understand and see where a firm's cash is coming from and where it's going, while the indirect method is less time-consuming, especially if a firm establishes a system for tracking non-cash accounting items. To provide clear information about what areas of the business generated and used cash, the statement of cash flows is broken down into three key categories. The three main sections of a statement of cash flows. Operating activities. The operating section reflects cash flows generated by and used by the day-to-day operations of the business. As mentioned, operating activities are those that are used or generated by the day-to-day operations of the firm. The operating activities section of the statement of cash flow begin with net income. All lines thereafter in that section are then adjustment to reconcile net income to actual cash flows by adding back non-cash expenses like depreciation and adjusting for changes in asset and liability account. For example, depreciation is a non-cash expense. Thus, depreciation is added back to net income. Investing activities. Activities include investment in other firms as well as investment in the firm itself, items like machinery, land, or other fixed asset. As mentioned, investing activities include investment in other firms as well as investments in the firm itself. These are items that are capitalized, placed on the balance sheet, and depreciated over time, and thus did not reduce net income. They did, however, cause an impact to cash flow. Financing activities. Financing activities are those used to provide funds to run the business, like loans and interest. Recall that financing activities are those used to provide funds to run the business. Common items in this section of the statement include the payment of dividends, issuance of common or preferred stock, and issuance or payment of notes payable. Any business's activity related to financing and fundraising effort is included in this section of cash flow statement. Operating cash flow. Operating cash flow is a measure of the amount of cash generated by a company's normal business operation. Operating cash flow indicates whether a company can generate sufficient positive cash flow to maintain and grow its operation. Otherwise, it may require external financing for capital expansion. It depicts the cash generated or used by the primary business activities. Remember, operating cash flow is calculated under the indirect method by adjusting net income for non-cash expenses like depreciation and adjustment for changes in current asset and liability accounts. Operating cash flow is an important benchmark to determine the financial success of a company's core business activities as it measures the amount of cash generated by a company's normal business operation. Here is the formula of operating cash flow. Operating cash flow is equal to operating income plus depreciation minus taxes plus changes in net working capital. Free cash flow. Free cash flows represent the cash that a company generates after accounting for cash outflows to support operations and maintain its capital assets. So here is the formula of free cash flow. Free cash flow is equal to operating cash flow minus capital expenditures. Managing cash flow. It's about understanding the flow of the cash, like how much is money coming in, which is the income, and how much is going out, which is expenses. Ensuring you have enough cash on hand to handle your obligations. It's about managing the business finances responsibly. Understanding your cash flow in and out allows you to make informed financial decisions. You can see where your money goes, identify areas of improvement, and plan for the future. Cash flow management is an important aspect of financial planning, and it can help a business to stay financially stable and avoid financial challenges, such as bankruptcy or default on loans. Some common strategies include forecasting cash flow, conducting a cash flow analysis. Cash flow management is crucial to a company's financial stability. As we all know, cash offers a valuable safety net against financial crisis, but only when properly managed and analyzed. According to U.S. Bank study, 82% of small businesses fail due to poor cash flow management or misunderstanding of how it contributes to business continuity. Cash flow management tracks and coordinates a company's past, present, and future expenses. It ensures that an organization is paying its invoices on time, adequately compensating staff with room for salary growth, and managing funds for future investment. A concrete understanding of the way cash flow affects business not only minimizes the risk of closure, but can ensure continued success and increased revenue rates.
A common-size income statement is financial statement that present each line item as percentage of base figure, usually total revenue or net sales, that is allowed to essay comparison different components of the income statement across time period or between companies of different sizes. Helps to identify trends and analyze the relative importance of each expense or revenue category in relation to the total revenue. A common-size balance sheet is financial statement that present each line item as a percentage of base figure. Typical total assets similar to a common-size income statement, it allows to easy comparison of different components of balance sheet across time periods or between companies of different sizes. This format helps us analyze the composition and structure of a company assets, liability, and equity, making it easier to identify trends and assess financial health. Analyzing organizational performance involves evaluating various aspects of a company operation, strategies, and results to assess how effectively it is achieving its goals and objectives. Defining the accounting period involves specifying the time frame over which financial transactions are recorded and financial statements are prepared. It is a fundamental concept in accounting that provides a basic for organizing and reporting financial information. The time period principle, also known as the periodicity assumption, is a fundamental concept in accounting that states that the economic activity of an organization can be divided into specific time periods for financial reporting. Fiscal year is a 12-month period used for financial report and tax purposes by business and organizations. An annual report is a comprehensive document that provides shareholders, investors, and the other stakeholders with detailed information about the company's financial performance, operation, and outlook over the past fiscal year. The Security and Exchange Commission reporting requirements are regulations established by the U.S. Security and Exchange Commission that govern the disclosure of financial and non-financial information by publicly traded companies.
Conclusion. Using the language of business, accountants are able to communicate the financial performance and health of a firm via 4 key financial statements. The balance sheet provides details of the company's sources and uses of funds. The income statement provides an understanding of revenues and expenses. The statement of owner's equity summarizes shareholders' accounts for a given period. The statement of cash flow tracks the movement of cash in the business. Together, these financial statements play a critical role in decision-making and evaluation for various stakeholders, including investors, lenders, and managers. We hope you learned something from us. If you have any questions, please feel free to ask them. Thank you for listening.